My name is Adam Spence. I'm the CEO of SVX in Canada. And many thanks for the first in a series of impact investing webinars. And today's topic will be an introduction to impact investing. And I can almost guarantee that this will be the most fun that you have today, or at the very least, the most fun you have before 5 o'clock. And also just want to recognize that this webinar is brought to you by the good people at Low Carbon Cities Canada and TAF. And also, as we begin, just want to identify a few housekeeping items. First off, this webinar will be recorded. It'll be made available to the participants as well as to folks on the web following this conversation. If you have any questions, comments, concerns, need support, please just put those in the chat box. You can find that just in the thought bubble on your Microsoft Teams instance. We have a great team of folks that are going to be providing support on the webinar today, including myself, as well as Oscar, Mary, and Anyumi, and you can find them in the chat as well. And if you want to just take a moment to introduce yourself in the chat box, that would be great, including your name, your organization, and perhaps what you're seeking to learn today from the sessions, as well as from your fellow attendees. That would be wonderful. Also, as we begin, want to make sure that we acknowledge the Indigenous peoples of the land that we are working and living on today, and to acknowledge the importance of the land we each call home. In particular, I wish to acknowledge that I live and work on the ancestral traditional territories of the Anishinaabe, the Haudenosaunee Confederacy, the Wendat, the Mississaugas of the Credit First Nation, and many other nations, recorded and unrecorded, who have taken care of this land. And it is home to Indigenous people from across Turtle Island, and I'm very grateful to have the opportunity to meet and work on this territory. So what are we going to cover in this particular exciting session? So first off, I'll talk a little bit about SVX just so you have a sense of who we are and what we do as an organization. And then it's really broken down into two segments. One is a general introduction to impact investing, thinking about the impact continuum, portfolio allocation, history and trends, and some stakeholder insights. And then an opportunity to hear a little bit more about impact investing in action from a representative from TAF who will introduce during the presentation today. And this all will take place within 60 minutes or less, or this webinar will be free. So just a bit about SVX as an organization. We're a nonprofit, diversified financial services firm driving impact for investors, organizations, funds, and enterprises. We work across sectors from climate to food, Indigenous reconciliation and development, equity, housing, and community real estate. Really, we do 5 things: provide knowledge and insights. We help to develop products. We work with folks to develop funds. We also have a platform, and then we engage in systems change initiatives. We're organized as something called an exempt market dealer, like a designation for a financial institution or stock market, allows us to do the work we do in impact investing in the private markets. We operate across the country in Canada, but also have operations of partnerships in Mexico, and you can certainly learn more about our work from our website. So main point of the conversation today is to give you an introduction to impact investing. And I just note, again, if you have questions or things you want to dive more deeply into, put those in the chat box at the end of this particular segment. It should be about 20 minutes or so. We'll have that chance for discussion and questions. So first off, when we think about impact investing, it operates within a spectrum of investing. And there are lots of ways we can spend money with different and varying levels of return. What's also clear is there's also so many ways we can allocate capital towards positive impact. And there's varying levels of intensity, which we can achieve that impact through grants, impact investing, responsible investing. And when we think about impact investing, it's really at the core of delivering impact alongside return. And we'll talk a little bit about that, but there's also other means by which we can achieve a positive impact with varying levels of intensity, including responsible investing, which is opportunities often based on specific ethical guidelines, investing in companies that do have a positive impact, oftentimes would be seen in the public markets. And then more, screened investments, screening in and out for either screening out negative impacts, that's often weapons, or tobacco or other challenging risks, or looking at issues of governance, including diversity and inclusion on boards. And so we see that impact investing sits on that broader spectrum of capital. When we think about impact investing specifically, this is really an approach to investing, or a lens by which we apply to any investment decisions we make. And specifically, these are investments made into companies, organizations, funds, and entities that have an intention really to do two things. One, have a positive impact, and two, deliver some form of financial return. And so that could be an investment like a private equity fund focused on sustainable food, company like Investico, or financing green bonds that would be financing renewable energy projects. And we'll talk a little bit about a few examples as well as characteristics of impact investing as well. But that just gives you a sense, a high level of what impact investing is. When we think about adjacent topics, and this gets to the idea of there's different types of capital that we can apply towards tackling our most pressing problems. The idea of blended financing is also really important. And so this is the concept that you can bring both public and private capital, including philanthropic capital, to provide a stack of solutions that blend capital in different forms. And it's often inclusive of concessional and non-concessional. So this could be grants or first loss capital, and non-concessional or more market rate return. And this gets to the idea of we can bring together, in order to tackle the most pressing problems that we face, the very great array of capital tools at our disposal in one place in order to get the capital we need in order to develop housing projects or climate adaptation infrastructure, renewable energy facilities like solar farms. And the idea here is, how do we unleash and leverage capital from across sectors to create sustainable financing solutions, instead of thinking about it from one single source, be it from government or from the public or private markets, combining and bringing all the resources to bear to tackle issues from climate change to poverty.
Adam, sorry
Yes.
to interrupt you. We're hearing that it's a little bit hard. Some speakers are finding it a little bit hard to hear you. I'm not sure if you could turn up your volume or...
Oh, absolutely. My apologies.
Yeah. Thank you.
Is that better? Is that better? Is that better? Just give me the
Is that
thumbs up.
sounding better, Corinne? Adam, with Adam's volume turned up?
I'm just going to test again. Can folks hear on their side? If not, I can.
She's going to try her headphones, so.
Oh, sure.
Others are finding it's clear, so.
Okay.
Thanks,
Great.
Adam. We'll just continue.
Oh, for sure. Yeah, and stop me anytime. If folks have questions or any technical issues, just let me know. I'm happy to be able to make any adjustments or changes. And so when we think about, what impact investing is, it's often best described by the examples. And so what we see here, a key message is there's an incredibly wide array of impact investing products available in Canada across geographies, across sectors, from anything from place-based funds like Verge Capital in Southwestern Ontario to larger, private equity funds like Cycle Capital Management based in Montreal. And so there's this large and growing orbit of impact investments that you can find in your own backyard or across the country that have that opportunity to generate positive impact alongside return. And when we think about the scale of the market, it's also really important. And so globally, there's over $700 billion in capital dedicated towards impact investing assets, so approaching $1 trillion as of last marker. The Canadian market is 20 billion. Folks are organizing their assets and their impact investments increasingly around the Sustainable Development Goals. So there's a common frame by which we understand and seek to manage our impact. Folks as well are seeing positive performance, both in terms of impact as well as financial expectations, and they'd like to do more. So I think that the headline here is there's more capital, and folks are having a positive experience with impact investing. And we think about the core characteristics. So how do you build, or how do you understand what is and what is not an impact investment? Lots of ways to think about it, but we've developed a set of characteristics around impact investing we think is helpful. First is, does it have an intention to have a positive impact that seeks to tackle a market problem, a shortfall, or externality? It's different for different areas of impact, but when we think about a company or a product being set up to tackle the problem or challenge of climate change first, as opposed to set up to be able to generate a profit. So something like CoPower Solar Share, its bottom line intention is how do we increase the production of renewable energy, reduce carbon emissions. Also, that's measurable, so that there's an opportunity to be able to measure and report the underlying investments as well. So you can see the number of tons of carbon emissions that are reduced. It also has some form of financial return, that it could be return of principal, so a loan that returns your money back, or it could be above market returns. There's private equity funds and impact investing that are far beating market expectations. We also think about it in terms of scale. So scale being deep, changing a neighborhood, tackling an incredibly specific problem like return to prison for youth in Manitoba, or it could have a wide impact by changing a whole population or a part of the world. Oftentimes as well that we would apply standards to impact investing. So there are, not unlike ISO standards or building standards for sustainability, there are standards like the B impact assessment or the global impact investing reporting standards that can be applied. And then as said before, many folks would seek to align their impact investments with the UN Sustainable Development Goals. So just gives you a bit of a frame of what the characteristics are. When we think about impact investing as well, important to identify that it's not in and of itself an asset class, nor is it confined to one asset class. It's an approach that can cut across an entire portfolio. So you see here in the orange boxes, you have what are broadly described as alternatives, but can be segmented into direct investments or investments in ventures or enterprises or individual projects. Then private funds, which would be impact investing funds like mentioned before, Investico or Cycle Capital. Then you get to more the traditional kind of non-alternative public equities, fixed income products like large scale green bonds. There's some cash and cash equivalents like Van City Community Investment Bank has a number of those GICs or term deposits that are available. So you can indeed deploy impact investing as an approach across your entire portfolio. And that there is increasingly a large number of opportunities across asset classes as well. So when folks initially were talking about impact investing, particularly when it was first imagined as a word or as a concept in 2007, it was really limited to the private markets, but now you'd see here it again cuts across a range of asset classes across portfolios. I think it's well important to note when we think about impact investing in Canada, it is not a few organizations that are talking about it. There is a large, vibrant, and growing set of stakeholders that are driving impact investing, creating products, and building the market. And you'd see here a range of governments, foundations, financial institutions, intermediaries, and funds. And this is just a snapshot of who is engaged across the country, but definitely a large market. And this does not include global organizations like Grand Challenges Canada, FinDev, Sirona, Quality Fund, World Vision, and WUSC. So there's a large movement around impact investing. Let's take a look just a little bit around the trends, and so and particularly what's going on in the history of impact investing. So impact investing, as an approach, as was described, having impact, delivering return, it's very old. So you could argue that it has a history that dates back to the Quakers in the 16th and 17th centuries, where they were applying their business and capital approaches in order to tackle the issue of abolition of the slave trade. And then you move forward, fast forward in Canada to the early 20th century and the co-op and credit union movement, which sought to bring capital back to community and to have a positive impact in neighborhoods and communities across the country. Where it really took root in this timeline and more popularly described would be in the 70s, 80s, and 90s. And you'd see here a number of different institutions that sought to be able to create intermediaries and organizations that would practice the approach of impact investing. So anything from the Canadian Alternative Investment Co-op, was a set of faith-based organizations that brought together $7 million in financing in 1984 to invest in things like affordable housing or fair trade chocolate companies, to entities like the Atmospheric Fund and TAF, which was capitalized, over 20 years ago now, and has now adopted and formalized its strategy to be able to concentrate on impact investing. And so this again has a long and storied history. And I think where it's really taken root and sought to grow has been post the financial crisis. So in 2007 and 2008, you have things like the Canadian Task Force on Social Finance that was convened. RBC created the first fund. Ontario launched a social enterprise strategy. You have a significant growth in assets by the time we hit closing at $9 billion. And now Canadian assets being at 20 billion. So you have this significant market growth, and we think a trajectory which is straight up for impact investing in Canada as well as around the world. And there's a lot of trends that would support that particular movement around seeing more capital and more activity in impact investing in Canada around the world. And that is one, related to big banks and financial institutions that are making incredibly significant commitments to sustainable finance. So if you look at BMO, CIBC, RBC, TD, allocating hundreds of billions of dollars in capital towards sustainable finance and impact investing. And so each of them has made that a priority for their institution. And then we look at governments getting serious about impact investing and sustainable finance, anything from the Social Finance Fund, which is allocated now $850 million plus in capital to commitments by FedDev, SDTC in clean technology, also investments by Global Affairs Canada in FinDev and other innovative financing tools. And there's other multi-year commitments for inclusion in business and investing, as well as Canada created the Sustainable Finance Action Council to bring together folks across sectors to imagine how we can build this market in the country. And also that impact investing, this is part of where we see government going, but also many other actors, that this way that we approach investing, again, alongside other strategies of good community action, as well as good public policy, seeing it as a part of our response to COVID-19 and the structural inequities and challenges that we've faced. And so this is now seeking greater adoption as a result of we also see that the market growth of impact investing continues significantly upward. Looking back at 2010, impact investing was a $2 billion market, and now today it's over $20 billion. And asset owners, from pension funds to foundations to financial institutions, continue to make more impact investments and greater commitments to it. We've seen that, for example, in our Canadian National Impact Investor Survey, as well as where are folks thinking about making investments. And so climate action, which is what we're talking about today, and we'll get into more detail about it, but it's really a priority focus of impact investing in Canada and around the world. It is the top designated issue area for impact investors in Canada based on our survey data. And also the place-based impact investing is taking roots, and we think about where folks want to invest. They really want to invest oftentimes in their backyard. Our survey data shows that 80% of impact investors want to invest in their local neighborhood, their region, or somewhere that's close to them. And that billions of dollars have been invested in the US in the community development financial institution networks, as well as in other place-based investing activities. I think final trend, and there's lots more that we could talk about, including gender lens investing or equity focus, but is this idea, which is countering a common approach to investing, and that is that you can invest and have a positive return. And in fact, impact investing is demonstrating positive performance in comparison to market benchmarks. I said before, 95% of investors would report that their impact investments would be meeting their expectations. But it's not just about meeting expectations. Organizations from Morningstar to large academic institutions would report that impact investing in sustainable finance is market beating and market meeting. There was a study by NYU Stern and Rockefeller Asset Management that looked at 245 different studies and showed that 86% of climate action focused investments were at or beyond market performance. And so lots of trends there that we can see. Now, I think important is so what? So why is it important for folks like you that are thinking about investing or thinking about climate action? I think there's many reasons. So one is demand. So we see the climate crisis. It is ever present in headlines as well as in data and in many cases our day-to-day lives. And so there's an overwhelming demand for action on climate smart infrastructure projects, enterprises, as we move towards transition to a low carbon economy. On the other side, there's a whole lot of capital that's needed. And we need that for infrastructure, energy projects, conservation, energy efficiency, buildings, you name it. Thinking about an all the above approach to make that low carbon economy transition. On the other side, government revenues. We'd had a previous approach. I think if you look at the past 50 years of perhaps a reliance on government sources to meet a number of our needs, and that is necessary as a condition to tackle the problems that we face, but another necessary condition, because capital funding and support is restricted and operating funding is constrained, is new capital. And so when we think about then the alignment of impact investing and climate action, we see then there's lots of interest in climate action by investors, top 3 priority. These kinds of opportunities have the potential for scale that matches investor interest and capacity. These are investments in millions, tens of millions, and in some cases, hundreds of millions and billions in infrastructure projects and enterprises. And then it's proven to be successful. The track record over the last 20 years plus has been incredibly strong. And as said, the market data continues to prove that as a trend. And that there's financing leverage and revenue streams. So be it housing, which if you think about it from investing in climate smart buildings and energy efficiency, has revenue streams as well as assets for leverage to obtain financing. And then there's a ton of case examples. And when we think about signature impact investments, and those examples that we've talked about, and there'll be another excellent one spoken about today, have been climate action investments. And so great opportunity and need to be able to move and apply impact investing as a means of tackling the issues that we face. So that gives you a bit of a summary on what is impact investing and how does it apply to the work that you're doing. I'll just stop there and pause and see if folks have any questions. And apologies, I can't see the chat at the moment, but I'll maybe pass to Mary to see if there's been anything identified in the chat. And I'm also going to hope that folks can still hear me as well on my microphone.
Not seeing any questions in the chat next, but Steve, I think you have a question. Why don't you just let us know what that is?
Yeah, thanks, Adam. This is fabulous. Just curious, I know SVX has, I forget what it's called, almost like a matching platform. And I'm wondering for LC3s if there can be a geographic filter on that for each of the 7 cities, as well as how do we, feed that pipeline as a key goal of the Ottawa Climate Action Fund. Thanks.
Yeah, that's a great question. So I think there'll be lots of opportunities for us to kind of chat about how we can filter and identify opportunities and often do it in a pretty tailored way. And so as much as, yes, you can take a look from a geographic perspective, is that there is a significant amount of work required on identification and development of opportunities. And so as much as, yes, there's opportunities you'd find on the platform, I think, and this is maybe a trend we should also talk about, there's an underlying need to spend resources on finding and developing impact investments such that investors can deploy their portfolios to align with their impact needs and expectations. That's certainly something we do with a number of different clients and organizations. But thank you for your question.
Adam, Melina has a question about what does de-risking mean from your perspective? This is often something that's referenced, and she's interested in knowing more about that.
Yeah, it's a great question. I think de-risking is an important component of many impact investing strategies. We spoke a little bit about it. So maybe as a practice, it's often the application of concessionary capital. So a first loss capital or a grant or a junior position in a capital stack that comes from a foundation or a government or another source in order to attract other investors that may have more senior positions or otherwise would be more interested in the opportunity because it has that de-risking component. And I think as impact investing, although is vibrant and robust, continues to be something that is not necessarily well known by a lot of folks. The application of de-risking strategies does help to attract more capital and can make it more easier for organizations and institutions and individual investors to be able to place capital into opportunities. And so we've seen that, for example, in the place-based fund that we operate and work with in Southwestern Ontario, which has a roughly 10 to 20% de-risk position by a government grant, which represents first loss capital, that helped to attract a number of faith-based investors and foundations and institutions to be able to capitalize that. And that's a common strategy across even very large scale. And I could speak to another large scale opportunity, and that was the Toronto Community Housing Regent Park revitalization, which had a de-risking strategy that involved a government guarantee on an overall $1 billion revitalization, a $450 million bond, and the city guaranteed that investment to those financial institutions and investors that put the capital up for that particular bond in about 2010. And so it was an important part of the capitalization strategy. But it's a really good question and would undoubtedly be an entire webinar and session to talk about.
We have one more question, Adam, right now. It's about the comparison of impact investment returns to traditional returns, given that there's challenges in the current market since it's creating difficult outcomes. I'm not sure I expressed that fully. Kira, if you wanted to give Adam your question.
Yeah, I'm just wondering if there's any dialogue that you're aware of, Adam, in moving away from pegging impact returns as below market, when using the market as a reference point seems so antithetical, because it's the market that's creating these conditions that require us to think about ESG outcomes kind of despite what the market is doing. Do you see what I mean? It just seems like such an illogical reference point to say below market when we know the market is broken. I'm just wondering if there's dialogue about that in the sector right now.
Yeah, it's a great question. I mean, the market is arguably haywire in terms of, if you look at the past 20 years of returns and performance. And so I think there's lots of ways to look at it. One is there is an entire spectrum of returns in impact investing, some of which are 0% or concessionary, some of which are so-called market beating, but it's a range based on impact appetite, risk and return profile, and expectations of investors. So you can almost de-link what the market is doing with the expectations and needs of investors around the returns that they would require for their own income or their own portfolio. So in other words, as an example, it's okay, not that I'm endorsing it, but to invest in solar share at 5%, because that is going to deliver what I need in order to pay for my retirement, right? That's one. I think there's also an argument around the idea that impact investing is below market. I think the data definitely shows that that's not the case. You can achieve market beating, so-called market beating returns. So even for those that would sit and live in that frame around following the 100-year arc of the stock market or the day's returns on the stock market, then you can actually see that, yes, if you live in that frame, impact investing or responsible investing is still kind of beating that. And that's, again, to evidence around whether you're Morningstar, Rockefeller Asset Partners, NYU, or other large institutions can show you that data. That's good proof. But those are just a few thoughts on it. But certainly, again, welcome more conversation on that topic as well.
Okay, I think that's all the questions we have for now. And we have another chance for questions a bit later on in the session, so feel free to keep those in mind to offer us later.
Wonderful. Well, that's great. So thanks so much again for the questions, and keep them coming in the chat box. Happy to answer those. And delighted to move on to our next topic and speaker. And I have the very good fortune of introducing Nicole, who is the Director of Impact Investing at TAF. Nicole contributes to the growth of TAF's impact investing portfolio, drawing on experience that spans investment banking, corporate finance, and project financing. Prior to joining TAF, Nicole worked at Solarize Energy, where she evaluated and executed diverse transactions in the renewable energy industry. Nicole started her career at Granite Tower Capital, advising SMEs on M&A deals across Canada and in the US. Nicole holds an honors business administration degree from Western University's Richard Ivey School of Business and an MBA from INSEAD. Please join me in welcoming Nicole to the virtual stage.
Thank you, Adam. That was a very nice intro. So I want to, so following up from the really great information that Adam started with, I want to jump into what this essentially means at practice at TAF. And then I'll just remind you all a bit of housekeeping. Feel free to type in any questions you have during this into the chat room. Mary will keep an eye on that, and then we'll have another Q&A session after this. So I'll try to be pretty brief to have more time for that. I guess we can go to the next slide. Thanks. So starting with theory of change, what is it? It's essentially a methodology for planning, participation, and evaluation that's used to promote social change. So it defines long-term goals and then maps backwards to identify the necessary preconditions to achieve those. And it's essentially a description and illustration of why desired change is expected to happen in a particular context. And some examples of things that you should think about in a theory of change, or some specifications, are things like industry sectors, geography, business stage, market, financial instruments, things like that. When you're thinking about a theory of change for your organization, it's long-term thinking with a focus on outcomes and pathways. And there's 6 steps normally to go through to get to your theory of change. So the first one is that you're identifying a long-term goal and intended impact. Then you're going to list the preconditions that you need to get to that goal to attain it. So you're sort of mapping backwards the conditions that you need to achieve that. Identifying the assumptions that exist in the model. 4 is identifying the intervention and action steps that you need to take to achieve your desired impact. And then 5, developing some success metrics to assess your performance on an ongoing basis. And then 6 is writing a narrative to explain the logic and theory of this practice. So Adam, if you switch the thing, in practice at TAF, our theory of change has led us to develop this investment thesis. And this essentially summarizes our long-term goal, which is carbon reduction, and identifies the actions that we're going to take to achieve it. So co-investing in enterprises and projects, developing innovative financial structures, and then collaborating with our other TAF teams, so grants, policy, and programs. I wanted to note that this is the latest version that came out of our strategy sessions that we had with our investment committee in Q4 of 2021, and that our thesis definitely changes over time. So we do review this on a regular basis every couple of years to make sure that we're still focusing on the appropriate areas of the market, business stages, financial instruments, et cetera. Inherent in this statement, innovative and market opening, is that we're making sure that we're adjusting to what's happening in the market, where capital's flowing and where it's not flowing, and adjusting our practice. Next slide, Adam. So from starting with an investment thesis, then we drill down to specific criteria for our investment. So This is an important step. So you're building the foundation of a long-lasting portfolio where you're designing it specifically to meet certain goals or whatever the goals of your center is. So using your theory of change framework helps to define what these objectives should be and helps set the stage for these criteria. And really having clear investment criteria, I think, is the core to choosing good investments, and then being able to measure those investments and measure your portfolio on a long-term basis. So if you go to the next slide, Adam, you can see some of TAF's overarching criteria. So you'll notice that the impact themes are grouped in the top row. So, big carbon reduction, clean tech, and a local benefit. These mandates are embedded in the decision-making process throughout the investment criteria. And I wanted to note that this investment criteria does not need to specifically apply to the entire portfolio. So Adam talked earlier about different asset classes. And so, for example, these investment criteria can be restricted to one or more asset class or sub-asset class, or they can be slightly different. You can think about them differently across asset classes. An example of that at TAF is the local benefit. So this is a strong focus for us when we look at direct investment criteria. So private equity and private debt. But for example, when we're looking at public equities, this is so just keeping in mind how your criteria apply to different asset classes, and again, how they fit back into your theory of change. Next slide, Adam. So we have invested our endowments across a balanced portfolio, so a range of asset classes. What you're seeing now is actually the newest version of our target portfolio. So keep in mind, this isn't exactly what our portfolio looks like now, but this is a near-term goal for what we hope it looks like. Again, this is a mixture of asset classes that was chosen based on our theory of change. And we think that this breakdown helps us move towards achieving our goal of urban carbon reduction. The red box on the left is what is managed in-house by our impact investing, direct investing team. So these are much more mandate aligned, and this is where we report on the majority of our impact achievements. So in here, you'll find direct investing, which is private equity and private debt in enterprises and projects. These are projects that often have current pay. They have low volatility, targeted impact. And we also have in this box alternatives, which includes for us pooled fund structures like PE and VC funds. It also includes real estate and other alternative transactions. Again, these are mandate aligned, and we put a lot of thought into having diversity and making sure that we're investing in alternatives that show leadership in the spaces where we're looking to make market changes. And then the box on the right is managed through a combination of our in-house finance team and our external portfolio management company. And so cash obviously used for flexibility. We are, this is determined through our budgeting and cash flow expectations. We have fixed income. These are used for liquidity. So if we have unexpected cash needs, it's secure. We can also potentially, borrow against things in this area. And then on the public equity side, again, some liquidity here, being able to sell if we need to. Diversity in the way that we look at public equity managers. And again, return generation is important here. And these are thematic. So they are related to our mandate, but they don't have the same carbon hurdles. But we do look for still carbon-free investments in this area. Again, as I mentioned earlier, what's on the right side here, not focused on, for example, things like a local impact. We can go to the next slide, Adam. So for return forecasts and return expectation setting, this can be either subjective or intuitive, or we can, you can develop complex modeling to figure out what that should look like. It's important to note that these returns can shift dramatically between periods, and they often shift, in tandem with or maybe against market and industry changes. So, return forecasts notoriously inaccurate. So we recommend, and what we do in-house is we keep our process of forecasting and calculating returns pretty simple. We're trying to reduce complexity to give ourselves more clarity on the outcomes. At TAF, for funds that are managed externally, we have average expected returns across asset classes, and that's what we use to budget. For the internal funds, for direct investing, we're using contracted or projected returns at the time of investment, unless we have some sort of reason to believe otherwise, some sort of impairment or something like that. And then for alternatives, it depends on the exact investment. For example, for pooled equity funds, for a lot of times we don't project returns for budgeting purposes because of the unpredictable nature of those returns. It really depends, but all of that to say that when we're projecting for budgeting and for return projections, we're really trying to be as conservative as possible and reduce the complexity that's involved in that process. Next slide, Adam. Okay, so when we're looking at new investments, you know, if we're seeing new investments, they pass our theory of change, it makes sense with our investment criteria, then we go into our sort of early screening process. And this is really designed to be quick and efficient to assess investments fit with criteria and whether it matches our goals. So normally for us, this looks like an initial meeting with the founders or the team that's designed to give us an overview of the business model and their intended impact. And we have, you know, some pretty standard questions that we ask during these initial meetings, and then we take that back to our direct investing team where we discuss whether we think that that investment is a potential fit. If we do, the next step for us is a carbon screen. So we introduce the company to our GHG quantification team at TAF to make sure that the impact is high enough, the carbon impact, and that there's enough local impact. I did want to note that I think that there have been early screen checklists sent around as a resource, and if they haven't, they will be included later on. And also I wanted to note that this process is really designed to help us get into a no decision faster for any potential investment. So, you know, we come across hundreds of companies in a year, and we need to be able to really quickly and efficiently filter out the ones that are not the optimal fit. And I think the faster you can filter out those options, the more time you have to focus on really relevant or high impact ones. So that's really, you know, we're trying to screen as quickly as possible so that we can spend more time on some targeted ones. Next slide, Adam. So we only move on to a deeper dive or a more in-depth screening process when we're satisfied that the investment has a really serious chance of being approved. So this means that, you know, our team's interested, it fits with our theory of change and our investment criteria, and it has passed our carbon screen hurdle, which is really important. So this is the stage where we're asking potential investees to send additional resources and documents. Normally it's in the form of a data room. And that can be things like financial models, pitch decks, business plans, legal documentation, you know, reports that qualify their technology, things like that. We have a standard checklist that we look for, but it's also modified on a deal by deal basis, depending on what we're looking at. At this stage, we're also doing a lot of our own research. So we're doing market research. We're speaking to our investment committee or advisors who may have expertise in the area of this investment. We're calling the investees customers, suppliers, competitors. So we're doing like a really thorough check on the organization. And essentially when we're satisfied with our due diligence and we're ready to make a request for an investment, we would write up a summary of our findings and present them to our investment committee and board for hopefully an approval. I guess on this note as well, I think there's also due diligence checklists that were either provided or will be provided as a link following this summary. But that's really like, I mean, this is really an overall very quick process of how we got from our theory of change to screening out investments and trying to get to the optimal investment for us. That is, you know, that is the end of the presentation. It's a bit of a cliffhanger, I guess, but tune in for the session next week when we're going to talk about actual investments. So we'll take it to the next stage. But let's open it up to questions right now, and feel free to unmute if you have a question, or else type it in the text box and Mary will be reading them out.
Thanks, Nicole. There's a question about our process for GHG emission reduction assessment. Do we do that ourselves, or do we rely on investee company estimates?
So we do it ourselves. We have our team in-house that publishes a methodology, and they publish, for example, an inventory report every year for the local area. And so they do that process. They work in tandem with the company. We will, make the introduction to them. They have a standard set of questions that they ask as well to help develop that calculation. We also see this as a bit of a value add that we provide to the companies, because we're helping them develop this calculation, and they can walk away with that calculation and provide it, to other investors, and they can continue to track it on their end. But we do develop that with them in tandem.
Jonah has a question. Jonah, do you want to unmute and ask Nicole your question?
Sure, and I'm not sure always what the right language is in this space, but we look at both. I'm with the province of Nova Scotia. We tend to look at both short-term greenhouse gas emission reductions along with transformational projects that might lead to significantly more greenhouse gas reduction in the future, but don't have an immediate GHG impact. So do you look for those secondary kind of transformational projects, and how do you do your accounting on the GHGs when you're looking at those types of projects?
We do. So we do take that into account. I will tell you that I think, in the past, those types of projects have tended to come up more on the granting team than they have for on the investing side. But when we do come across projects like that, we have a specific hurdle rate, which is 500,000 megatons, that projects that we need investments to hit to be sort of a hurdle. And when they don't meet that, but for example, there's some sort of enabling technology, or they're going to drive broader systems change, we do consider that and we have that discussion with our investment committee. So that would be, a bit more of a qualitative process discussion that we would have within the team as to whether that continues to make sense. So we will consider that, yeah.
Peter's asking, what volume are we dealing with?
Volume in terms of number of transactions, volume.
Peter, maybe you can elaborate your question.
Yeah, I was just trying to figure out the volume that you're evaluating on a regular basis, just to get a sense of, how large is this portfolio potentially looking at?
So we have, our goal is to have $30 million invested in direct investments. We're not quite there yet. We're, around closer to about 15. Last year, for example, we approved, I think, 7 transactions that were just over $5 million in total. I would say, in a regular given year, we probably come across 250 companies in total. And we probably have introductory calls with about 50 of those. And we're probably doing deep due diligence, or we're probably getting to like a pretty deep level of due diligence on around 15 to 20 of them, to come out at the end investing in around 6 or 7. I think those were the stats for last year.
Oh, that's helpful. Thanks.
No problem.
Brian's asking about, are your bond and public equity assets carbon free?
So our public equities are certainly invested thematically. So yes, looking for carbon-free investments. Our bond, not so much. We have found it more difficult to find mandate-aligned bonds. And I know that is something that we are hoping to add to, our list of, we're doing a search this year for some more alternative investments. And, that's also something that we're thinking of on the bond side as well.
Thanks. Lots of great questions here. Kira's asking, when you're evaluating your risk at the screening stage, do you consider the risk associated with not seeing the venture or enterprise launched or scaled?
I guess we do, from the perspective of, if it's something that we really want to be launched or scaled, then we're probably looking to make an investment. We really see our role as mobilizing capital into areas of the market where it's not necessarily as free flowing, or maybe where other investors perceive risk that either we don't perceive or that we're willing to take. So if it falls into one of those categories, it's certainly an investment that we would want to look at. But again, we're staying really true to our investment criteria. And, you know, sometimes you come across a company that is a really great and really wonderful technology, but just doesn't fit in our investment criteria. So we have to be really diligent about moving to that no and making sure that we take it off the table for ourselves.
Great. Quick question about GHG assessment. Does it assess the potential benefits at scale?
Yes. So we look at the GHG assessment at scale, both from the perspective of the company and from the perspective of what the market looks like. So for example, if we're looking at a technology that, you know, has it reduces carbon emissions in houses, we're going to look at what can that company do over the next few years? What does their business plan look like and their scale up? But then also, how big is the potential market in the Greater Toronto Hamilton area? How big could this be? If this company is successful, do we expect competitors? What do we expect that market to look like in 10 years?
Okay, Vicky, you have a question about screens and levers for returns, if you want to bring that forward.
Yeah, thanks. Great. Thanks, Mary. So, I mean, TAF has been doing this for quite a while, and I wondered if you've been able to develop some kind of rule of thumb when you're applying your different screens, whether it's carbon return versus geography versus social returns, and use those levers to impact on the actual total return. So if you do more of one kind of screen that is more heavily weighted, your returns go up. Have you been able to develop that kind of understanding?
I'm not sure I'm following the question. So you're asking if we screen, for example, if we set a higher impact hurdle rate, would the returns go up? Is that what the question is?
That kind of thing, yes. Yeah. Because you said you've used multiple returns. So if you heavily weight the social return, do the returns go up or down? So
in the past, I mean, in the past, the screens that we've had have really been, you know, the GHG impact at scale and local. And we haven't, on the impact investing team, we haven't measured co-benefits and health and things like that in a formal way in advance of an investment. And so we are learning as part of the, you know, LC3 process to set up these co-benefits and impacts. But I don't think we've developed any sort of specific relationship that we've seen between impact and returns that is true, that overarching over all of the different types of transactions that we do. I will say, like, we do because a lot of what we do is custom and financial innovation, and we're really flexible with our financing terms. No two transactions look alike. We've never done two transactions that look the same. They're you know, except on the maybe alternative side where we're an LP in a portfolio, but they always look different. So it's difficult to sort of to know how those levers affect everything overall.
Yeah, great. Thank you. I just wondered, you know, the many years of this interface, whether it was possible to do, but thanks.
No worries.
Nicole, a couple of questions on the investment thesis. Maybe could you give an example of a significant change in your investment thesis that you've made over the years? It's the first part of the question. And also, is there some trends you're seeing right now that might lead you to change your investment thesis next year?
So I will say in, you know, a specific, this is not written into the investment thesis, but I will say a specific thing that we've changed about our investment focus this year is that we previously had identified electric vehicles and mobility as a core target area for us on the impact investing side. But what we're seeing in the market is that there's actually quite a lot of money in electric vehicles and around mobility. So while we remain interested in transactions that are unable to access financing, it's not going to be a core area for us look for, you know, the coming year. So things like that, like how we're seeing the capital flow in the market sort of affects what we're looking at. For example, some years we're doing a lot more project finance because that's what we're seeing in the market and that's where capital is needed. Right now we're seeing a lot of companies, for example, in circular economy that have really capital intensive projects that they want to do, which are not that popular with a lot of venture capital private equity funds, which are looking for low capex investments. So, you know, as the market's moving, we're sort of shifting our target investment area.
Okay, we have another question about the local screen and how do you balance this aspect of the GTHA focus versus companies might achieve emissions reductions by scaling to other jurisdictions?
So for us, this means that every single investment we do has to have some sort of local benefit to the city of Toronto or the greater Toronto Hamilton area. And so what that can look like is it can be that it's a company that exists in Toronto or exists in Hamilton and is scaling in the area. It can be that, you know, it's a project that's located in maybe Quebec, but it sources feedstock from companies located in this area. So it could have customers here, it could have suppliers here, or it can be that it's a technology that the company, you know, we've invested in a company in Minnesota a few years back that really wants to do a lot of projects in the Ontario marketplace. That's one of their next core demographic areas. So, you know, it's a company that's really has immediate plans to be in this area, or their product is viable in this area. So we just have to demonstrate somehow that there's a benefit to our catchment area.
We're just coming up to the end, but there's a couple of questions at the end about practical issues of the TAF team. How big is the TAF team doing the due diligence? Could we be able to estimate average staff hours per project? And also, what kind of skill sets does TAF have to do this kind of vetting and due diligence to get the number of projects that we're running each year?
So our team is really small. There are 4 of us. I think it would be really hard to estimate staff hours on each project because it really depends. For example, it's a lot less due diligence hours when we're investigating, for example, a second fund of a private equity group that's already existed before. Or if we're starting with an entrepreneur who's in the early stages of development of a clean tech project, and it's going to take them maybe 2 years to get ready for an actual investment. So, you know, there are some projects that we work alongside the entrepreneur for a few years before we make an investment. There are some projects that can come together much faster because, for example, maybe they're raising capital or a company's already going through a capital raising period, and we're just going to be one part of a broader capital raise. So that really depends on, you know, the readiness of the company and the technology. And then on the skill set side, so, you know, we have a range of skill sets on the team. We have tried to cover our bases, but what I think is important is really having a range of skill sets on our investment committee. People that have worked across, you know, different industries and different investment structures, different investment types, and have, you know, varying amounts of experience. Because we really do rely very heavily on them for advice on specific transactions, whether that's structuring, whether that's, you know, are we, you know, is the coupon rate appropriate? Does the structure make sense? You know, reviewing risk through legal documentation, things like that.
Thanks. We're at time for today, and there's a couple more questions, but I think, you know, we could capture those and get you the answers to those afterwards, and we'll just wrap it there. I just wanted to mention that we do want to, if you can fill out a little survey for us about how you found this session, because we're trying to create sessions that are helpful to the practitioners. That would be great. We'll send that out to you today along with a copy of this deck, which people have been asking for. And I'll just speak to this next workshop number 2 next week, same day and time, February 24th, 1 to 2 p.m. Eastern Standard. And we're going to be presenting a number of case studies with some guest speakers who are in the field. And this will be followed by an optional Ask Me Anything session. So you get a chance to dig into some of these case studies and see how these principles that Adam and Nicole have provided today play out in real life examples. Thanks, everybody.
Thank you.
Have a great day.
Bye for now.
Thanks so much.